I was actually quite a bit more encouraged about silver earlier this year because whereas last year silver had been correlating more with copper than with gold,
Hmm.
this year, really starting last fall, when the second war or larger scale war erupted in the world stage, we
Hmm.
saw silver acting much more like gold or as a monetary asset or alternative to the dollar should. But in the last couple of months, it started looking more like copper again. And so that doesn't turn me bearish, but it makes me think, well, in the first place, even a silver bull will tell you that in a bull market, silver lags gold initially, and then it more than catches up. So on that basis alone, there's no rush to to pile into silver right now.
Gold has experienced a notable rise recently, climbing approximately 20% over the past 6 months and approaching historical highs. Currently, the price per ounce is $2,499, reflecting a decrease of $21, while prices per gram and kilogram have fallen to 80.34 and $80,342.85, respectively. Lobo Tiggre, an expert in natural resource investments and founder of IndependentSpeculator.com, offers valuable insights into the precious metals market. He notes that gold has been hitting nominal all-time highs since 2020, with several new peaks this year. Gold and silver typically move inversely to the dollar, rising when it weakens and falling when it strengthens. However, silver is notably more volatile and has been subject to price manipulation by banks for over 40 years, aimed at suppressing its value for industrial use and to profit from market positions. Earlier this year, Tiggre expressed optimism about silver, observing that it initially behaved like copper, but began to act more like gold following a major global conflict, emerging as a monetary asset or an alternative to the dollar. Despite this, a significant divergence remains between gold and silver, with gold continuing to set new highs while silver lags. Tiggre advises caution regarding silver investments at present. Although he maintains a positive long-term outlook for silver, he highlights that its recent behavior and potential correlation with copper during a possible recession suggests that investors should be wary of making heavy investments in silver at this time. Before watching this video, please subscribe to our channel and hit the bell icon so you never miss an update. Also, please share this video with anyone who might benefit from it.
I was actually quite a bit more encouraged about silver earlier this year because whereas last year silver had been correlating more with copper than with gold, this year, really starting last fall, when the second war or larger scale war erupted in the world stage, we
Hmm.
saw silver acting much more like gold or as a monetary asset, alternative to the dollar should. But in the last couple of months, it started looking more like copper again. And so that doesn't turn me bearish, but it makes me think, well, in the first place, even a silver bull will tell you that in a bull market, silver lags gold initially, and then it more than catches up. So on that basis alone, there's no rush to pile into silver right now. And then on top of that, you have this higher correlation with copper. And if copper's headed lower into the recession, it's hard to see that not being a downdraft on silver. That doesn't mean it's the end of the story for silver. Silver's done, whatever. It just means that if I'm looking to deploy cash into speculative investments, and the odds are, if not high, that silver will go lower before going higher, they're at least not high that silver will just take off right away. I mean, look at this. We've got new all-time highs, at least nominally, in gold repeatedly since 2020. And this year we've had nominal high after nominal high. We're still holding near those. And, rate cuts are coming and other things that are very bullish for gold are visibly on the docket, like in the month or months immediately ahead,
Yeah.
starting at $2,500 gold. Whereas silver, it's like the little lady in the commercial, I've fallen and I can't get up, right? It got whacked
Yeah.
in 2020. They both spike down and gold comes, roaring back up. So they track, if you change it to percentage gain basis, as I remember it,
Yeah.
gold comes
Let's do that.
screaming back up and silver never caught up. It's been 4 years now and silver hasn't caught up. It makes me nervous to see silver tracking copper recently. If you're in the hard landing camp, that's bad news for copper, for oil, for nickel, lithium, everything else. Doesn't matter if they're already cheap. They can and will go lower if I'm right about the hard landing. And if silver is acting like those industrial metals, then that's a concern. This chart you're showing me, that's not a chart I've seen displayed this way before. I'll have to go back and look at this. But it says that I should keep silver lumped in the gold basket more firmly and not worry about it so much. So
Lobo Tiggre highlights that some believe inflation is not linked to money printing or the money supply, but reflects economic confidence and strength. They argue that managing inflation, viewed as a symptom of an overheating economy, requires slowing down economic activity. However, inflation can occur without an increase in the money supply, as it is also influenced by supply and demand dynamics. For example, geopolitical tensions in the Middle East can drive up oil prices due to supply concerns, illustrating how external factors can affect inflation independently of the money supply. Tiggre also points out a stark contrast between official inflation rates and the actual inflation experienced in the mining sector. While official inflation rates hover around 2 to 3%, mining costs, including equipment and capital, have surged by 50% to 100%, indicating a much higher inflation rate. Similarly, J.P. Morgan Research projects that global core inflation will remain around 3% in 2024. Despite anticipated declines in headline inflation, factors such as a slowdown in goods price deflation, tight labor markets, and strong demand are expected to keep inflation elevated and limit reductions in service prices. Let's get back to the interview.
I mean, there's the old Milton Friedman thing, always and everywhere, a monetary phenomenon. And by the way, gold bugs only want to hear so often, yay for my side. But when that line was going down, I was pointing that out. I said, like, look, you guys, if you're going to say inflation is always and everywhere a monetary phenomenon and the money supply is decreasing, you have to recognize that. You have to say that that is a deflationary factor. Doesn't mean necessarily we'll have deflation, but it is a push in that direction. As the various vectors of force here, that is a downward push. So it is very significant to me that's turned around, long and variable lags. Inflation doesn't turn the moment the money supply does. If you think about the logic of how that works, you create money, you pay somebody, some government contractor, they go out and buy bread and buy gas, it moves in waves out through the economy. It takes a while for the increases in money supply to show up in prices. Like inflation is not about money printing, has nothing to do with the money supply. It's about confidence, and it's about, it's a sign of the strength of the economy. So, this is why we want to tamp down the economy to try to control inflation, because they believe that inflation is a symptom of an overheating economy. So I think that model is simply wrong. Like the fact that these models can't encompass the concept of stagflation, which can happen and has recently happened again in some countries. We've seen something that if not repeating exactly, it rhymes a lot with stagflation that we've seen before. So we know these models are wrong. And it's no surprise when they're constantly surprised by things like, inflation going up to 9%. The mainstream didn't see that coming because money supply had nothing to do with it. And so they're projecting out over a decade. And if they said, okay, in the first year, these policies will spend this much and the difference on inflation will be this much, that would be more credible. You could look at which one has the most immediate spend and what the impact of that might be. Also, if you were to inflation adjust that chart, you would see, the part that looks lower now, like the copper still, you could say, oh, okay, it's down, but it's still up. Well, but if you inflation adjust that, it's not up as much as you think. And that's using CPI. If you look at the actual world of mining and what it costs to get miners out there these days and the cost of equipment, tires and things like that, the inflation is nothing like, never mind the 2 or 3% now. It was nothing. It was not like the 9% we had back then. You were seeing cost increases of like 50 to 100% in equipment and sustaining capital costs in mining projects. So, it looks like, hey, the copper's not doing so bad, but in the real world, we need higher copper prices if we're going to, never mind the green agenda, if we're just going to provide our civilization with this fundamental industrial metal that it needs.
Gold and silver are navigating a problematic inflationary landscape. Although official inflation rates remain low, mining costs for these metals have surged by 50% to 100%. Looking ahead to 2024, global core inflation is anticipated to hold steady at around 3%, driven by tight labor markets and robust demand. These factors are likely to have a substantial impact on the prices of gold and silver, making them essential assets to monitor. How do you believe current inflation trends will influence the future prices of gold and silver? We invite you to share your insights and predictions in the comments below. If you found this video valuable, please like, subscribe, and hit the bell icon to stay updated on our latest content. Thank you for watching, and we eagerly await your thoughts.